Good morning, folks. Happy Wednesday. Happy hump day to everyone. Before we get into the nitty-gritty of today's piece, today's briefing, really, let's just see what happened during APAC trade. So we had positive trade pretty much across US, sorry, not US, Asian equities, and this due to stimulus promise from Beijing, which will cover both fronts, monetary and also fiscal channels. So we've seen, I mean, these bourses have seen multi-day down days. So this is showing that the markets are taking the roll up positively, uh, despite COVID zero still hanging in the balance. The Royal Bank of New Zealand hiked rates for the fifth straight time, but this was expected. However, we see the Kiwi just rampaging away. So the OCR is now set at 2%. Crude is up due to tight supply and strong demand expectations. Uh, Looking into H2 with the whole stimulus program going on. Um, so What's the big deal today? Apart from data, which we will be getting the German consumer sentiment. This is prelim data, so it would potentially be market moving for June. So it's at 7 a.m. GMT. We're expecting a reading of 26 from a prior 26.5. Durable goods for US expected 0.69, 0.6% from a prior 1.1%. So we're expecting a drop there. Before getting the FOMC minutes at 7 p.m. GMT. So this is the thing that I would like to talk about. And why is this a big deal? Well, obviously it's Fed minutes, but what we are looking for are any discrepancies because we have had basically Michael Barry and Bob Prince from Bridgewater Associates pretty much ganging up on, with saying that the U.S. economy is pretty much done for in a way. Michael Barry said it's like watching a plane crash. Water Associates CIO Mike Prince, sorry, not Mike, Christ, Bob Prince, said that he sees the US economy on the cusp of a stagflation. So, with these two big players in the industry saying stuff like that, like you would, and with the multi down days that we've seen on US equities and pretty much equities and risk assets in general, um, this is due to the fact that in May, the Fed May meeting, they came out extremely hawkish. So they hiked rates by 0.5%, looking at an increment. Well, so it's 50 bips increment to set the rate at 0.75 to 1%. And saying that once we get there, ongoing rate rises will be appropriate. Understandably, at this point in time, inflation readings globally, not just the US, but I mean, we're talking about the US right now. It was running red hot. 75 basis points was still not on the table. However, it is still a tool that could potentially be used. So this was pretty punchy stuff, and they would begin the first phase of balance sheet normalization that would start in June. At first, they said it might start in May, but no, starting in June. Still, just a big deal. So after a 6-month period, Powell said, Fed Chair Powell said, looking at the normalization to be equivalent to about a 25 basis point hike. So, and despite first quarter GDP readings being less than pretty, he says household spendings and business fixed investments are still look positive. So that's what he said then, and this was May. So this is why this is a big deal. It's in terms of, okay, they were super hawkish then, okay, but they can't just roll back, or else whatever they say won't be taken into account in the future. Like, no one's going to trust them. Communication is one of the Fed's biggest, uh, basically, tool, right? It's interest rates and communication, all right? So it's evident that they are really serious about bringing inflation down, which is understandable. But and right now we are also on the cusp of this major growth slowdown. That would come from a seriously quick rate hiking cycle, and this is what they are trying to pretty much like maintain a balance within fighting inflation and not let the market crash. But according to Michael Berry, he's saying, it's like watching a plane crash. Like, in my mind, when you say that, like, if you see a plane going, just a plane crashing, like on the way down, it's like there's really not much you can do but just brace, right? So, but So how would a dovish hold look like now? So how can they communicate? Okay, we are hawkish still. We know we need to fight inflation, but how do we maintain a degree of not letting everyone freak out and watch basically the economy crash and burn? Uh, we could get potentially communication on uh, lowering the terminal rate. So, and once the rate actually gets to neutral, they then say, okay, once it gets to neutral, instead of saying ongoing rate rises will be needed, now they can say, okay, once we get there, we'll pause and wait. Right? This is not the current communication, but they could say this. So it's hawkish, but it's less. And then the second thing is they can say, okay, so 75 basis point hike every increment. Like, no, we're not going to do that, right? So the moment they take that off the table, they're saying we're not going to use that as a tool. Then, okay, that's because markets price in future expectations. So once that is no longer on the table, okay, we are going to see rate rises, but it's not as bad as we first expected, right? So any questions at all, please just feel free to hit the comments. I hope this helped, and have a great session ahead.